So thank you everyone for coming. Welcome. I know a few of you have traveled from very far, and then we have quite a few locals. Today is a very exciting day for me because we are going to be discussing what I know is on everyone's heart, what's going on with gold. So let's jump into it. So let's look at the last year. What has happened the last year? Now, I'm not going to use year to date that we normally use. I'm going to use the last year just because the tools that I use has changed a little bit. So over the last year, this is one of our clients' investments. Now, I'm sorry that we can't see the figures too great there, but this is just a quick graph of a client of ours' investments. This specific client is drawing an income of around about 7, maybe 8%. The client's retired, so on a monthly basis, he's drawing an income. The bottom line is his capital has gone up with about 100,000 Rand over the last year despite drawing an income. I want to cover 3 topics, and then I'm going to take these 3 topics and I'm going to put them into one box. And I'm going to show you how these 3 different points, the S&P 500's long-term history, the US's debt to GP ratio, and the US interest rate. I'm going to talk about these and I'm going to put them together. I'm going to show you why gold is still good and why we should have no concern for the short-term volatility that we've got in the short-term downturn. So this is the 90-year history of the S&P 900. Anyone here 90 years old? If there was, this is as old as you are. This is a very, very long track record, and we can see a lot from this. Now, some of you have seen some of these slides. I know that I've shown some of you some of these slides, but I've shared a lot more on it. So even you've seen this, there's some exciting things that have developed out of this. If we look at the 27-year period from about 1930 till close to 1960, the S&P 500 had a return of 0. So if you had invested $100,000 into it back then, you would have had $100,000 27 years later. If you fast forward another 29 years, same story, 0. Imagine as your broker, I come to you after 56 years and I say, here's your review, you've done 0 minus all my fees. You're not going to be very happy with me, right? That's the case with the S&P 500. The biggest portion of the American stock exchange, the top 500 stocks in the American stock market. The next 24 years, they had a return of 110%. If you calculate what that is on a compounded return, it's 3.3% return. Remember, this is the entire stock market, no broker involved. You know that our fees were the platform fees of 91 and the product and the fund portfolios, all of that. The fees are close to about 2%, depending on which fund we're in and depending which period. So you'd be walking with 1.3% return. Once again, you would not be happy if I came to you with that. The question I've got today is what happened at that point of time, the year 2008? Now, a few of you have got the answer because I've shared these slides with you. But what happened in 2008 that caused this abnormal growth? Because it's done 0, 1%, and then all of a sudden it's done phenomenal, and all of us sitting in this room today believe that the American stock market is one of the safest places in the world, right? Most people have got an undertone of trust in the American stock market. Am I correct when I say that? A lot of people think that America is a great company and it's safe to invest there. I'm going to show you today why I don't believe that. In 2008, I'm going to read there, at November 25, 2008, the Federal Open Market Committee meeting, the Fed announced QE1, known as quantitative easing. It would purchase $600 billion in bank debt, US Treasury notes, and mortgage-backed securities from member banks. The Fed started quantitative easing to combat the financial crisis in 2008. Let me explain this in layman's terms. They have printed money. They've got a printing machine, they print money, they take the money and they pay other people out. So people who have invested in the government bonds, they would pay the people out with the fake money that they printed. They would give people the money back with the idea that those businesses would now have cash flow reinvested into the economy and then boost the economy. But the emphasis being on fake money. They've printed money to do this with. And that's going to be the undertone of this entire presentation. So hold the thought of printing money. And I want to leave this analogy with you and keep this in the back of your mind for the rest of the presentation. If we are sitting around a table and we're playing Monopoly, and we all start with equal shares money, and I run out of money, and I just say, just hang on guys, I want to go to the loo, and I run to the loo, I go into my bedroom and I grab another stash of Monopoly money and I come back and I put it on the table and I continue playing. You're not going to be playing with me for very long, right? You know, nobody wants to play against somebody like that. That's what America is doing right now. I'm going to show you that. So in 2008, they printed 600 billion US dollars. 2010, same thing, 600 billion US dollars. Between 2012 and 2014, $2.5 trillion. Now, I know I'm a financial guy, but even to a guy like me, those are numbers we don't really comprehend. So I'm going to put this into perspective. During the same 12-year period from 2008 up until today, that is the combined average of the South African GDP. Now, GDP is our gross product, so the total product that South Africa as a country has produced, it's the equivalent to that. So America has printed as much money over the last 12 years, up until earlier this year, as what the entire South African economy has basically had in turnover for the last 12 years, the same amount of money. Now I want to leave a question with you for all those people that think South Africa is in a really bad place. Is South Africa really doing that bad in comparison? If we keep in mind that the only reason America is doing well is because they're printing money. And I'm going to sound like an American infomercial, and it gets better. Well, in this case, it gets worse. So this is the same data I've just given you, but in a graph. You can see the America Fed, so the Treasury, the amount of debt that they had was sitting at about, I don't know, 900,000 US dollars. 2008, they printed the first 600 or so, and you can see the graph going up, and then they printed all the other monies. Now, this unfortunately, it says M, but it should be T for trillions. So that's just an error there. But if you look at from there to there, it was about 3 trillion US dollars that the amount of debt increased by over that 12-year period. Would you like to see what happened March this year? So has some of the fear of us being in gold just disappeared immediately right there? The same amount of debt they accumulated over the last 12 years, they've just accumulated in the last few months. Why? There you can see, CNBC, one of the big American newspapers, the Federal Reserve has just pledged asset purchases with no limit to support the market. They said, coronavirus has come out, it's going to devastate us. We know, because we're clever people and we know what's going to happen. We have to combat it. We only have one tool. We got a printing machine. We know it works. Let's just use it again. And they printed $3 trillion. There you can see the date. It's a little bit vague, but Patrick Duffy in the front here, you can tell us that that says March 23rd, 2020. They catchphrased this, quantitative infinite. Infinite. Now, there's only one thing that's infinite, and that's God, but they catchphrased it infinite. We will print as much money as is needed to keep the economy alive. That's the same information I've just given you in a graph. So the size of the Federal Reserve balance sheet since quantitative easing measures were introduced from March to October this year. Started at about 4.3 trillion to over $7 trillion. The worst news is that little insert that I put in there came in an email on Monday from 91 where they rate that that is going to increase to 9 trillion in the next 2 years. Well, year and a half. Now, this is the same S&P 500 I showed you over 90 years. I'm showing you the last 5 years. In fact, I actually only needed the last year, but I couldn't get that graph. That is March. So the stock market went from that crash to that peak because they printed 3 trillion US dollars. Now, raise of hands, who wants to invest in money in the all-time high S&P 500? There's no ways I'm putting your money as retired people into any overseas investments at the moment. Because the simple answer is, America leads the world. We all know that. That is a fact. But they are going to crash. And when they crash, they're going to take the entire world with them. That's the reason we are in gold. I know some of you sitting in this room has only been my clients for a few months, right? And some of you have lost a lot of money with gold taking a dip in the last short term. I need to ask you, please be patient. Just be patient. It is short-term volatility. This is going to phase out. The only thing that can happen is they can print a lot more money to keep it alive, but that's like taking a corpse, putting a few sticks around it and making it prop up. It's dead. The reality is the American stock market is dead. They can try and prop it up as much as they want. The day they stop printing money, it's going to collapse. It might be 3 years from now. I might not have the timing right, but I cannot take the chance putting your money as a retired client into there. My job is to protect your money. You've all given me your money for me to protect your money and to invest it into the right place. And I cannot invest it into this. This is that same graph I showed just now with the debt of the Federal Reserve, and then the same American stock market for the last 10, 12 years. So both of them are 12 years. You can see when they printed money, the stock market went up. When they printed money, the stock market recovered. It's the only reason the stock market is alive right now. Now remember I said we're going to talk about 3 things. Now the next one is the debt to GDP ratio. Now everyone's concerned about South Africa right now. Early this year we were sitting at about 60, maybe 65% debt to GDP. We're possibly sitting at like over 80%, close to 90, and everyone's concerned about that figure. But we haven't printed any money, and we've done worse. This is the American stock market. Now, that point in time there was the end of World War II. They sat at the highest debt they ever sat at. That is today. I would love to know, why is their debt sitting at such highs when you've had nothing driving that debt? Now keep in mind, you've got debt, tons and tons and tons of debt. You need to service that debt, right? At which rate do you service debt? At the interest rate. That's the third one we're going to talk about. So at the US interest rate, that's the rate that they have to service their own debt at. Now, their debt used to sit at high figures, but that was an all-time low, 0. And currently, we're back to that. Now, let me explain in layman terms how investments work. To stimulate the economy, the government has got a few tools. Now, America is choosing the tool of printing money at the moment, which is going to backfire on them. But an old conventional tool which country use, and which South Africa is using right now, is we've lowered our interest rates. You wouldn't know it because you don't have bonds, but my young people would know because we all have bonds. And as soon as the interest rates go down, we've got a few hundred or 1,000 or 2 more a month to spend. So governments lower the interest rate, and by lowering the interest rate, the collective population of people in the country have got more money to spend. Now, for one person, it's 1,000 Rand, it's 300 Rand more a month, but you multiply that by 10 or 20 million people in the country that have bonds, that's a lot of additional money for the country to spend. And when the country spends that money, it creates, it stimulates the economy, and the economy does better. Now, you got a little bit of a problem when you're sitting at 0. You got no more stimulation left. So the America government don't have any tools. Their pockets are empty. They don't have a tool right now. And that's the reason, and you'll see it dates back to 2008. That's why they had no other choice but to print money in 2008. And they thought it would work, and they're doing the same thing right now. I myself am not putting your money there. So I personally catchphrase this, fake growth. So if I compare all of that, again, I'm going to keep putting this into perspective. We're talking about a stock market that has done zero for 56 years. It thereafter did about 1.3% after fees. And you want me to believe them because they had a good few runs for the last 12 years. That has been based on fake growth. I'm asking you, why should I not be expecting the American stock market to go sideways and do zero for the next 20 plus years? Give me a reason why I should believe that it's safe for me to invest money into the stock market for the next 5, 10, 20 years. Because that's the lifespan that you've got. I've got to invest for the rest of your lifespan. I cannot guarantee that, and we can't guarantee anything, but I can't see a reason, and I'm quite optimistic, I can't see a reason for me to invest money into there. That's the reason why we cannot invest money into the American stock market right now. As much as 25% of the 60 trillion of global fixed income assets is trading at negative. So collectively, all the money in the entire world that is invested into fixed interest, so your bonds or, if you go put money into money market or something like that, so there's $60 trillion of that globally, collectively in the world. 25% of that is trading at negative. So you're putting your money into the bank and getting less money out 10, 20 years later. Anybody interested in an investment like that? I can sell you one quickly. No, we don't want that. You need to live off your income, and we need to get your capital to grow. That's the state of the world right now. So what do you think is going to happen when the American economy starts collapsing? It's going to be a domino effect going forward. Why did we get into gold initially? Before we ask that question, let me ask the question, when did we get into gold initially? Can anyone remember? July, yes. It was actually June, but yours might have been July. But June, I made the decision, 2019. When did coronavirus surface that we were actually aware of it? Only about February this year, if you watched global news, would you have known about it? Sorry, guys, the seats in the front. You're going to grab that. Okay, so we got into gold June 2019. There was no coronavirus. Now, my client pointed out the reason why my clients might have thought that we got into gold was because I increased the exposure during the middle of the coronavirus. So understand that you might have had the perspective that we got into it because of the virus, but that had nothing to do with it. I always wanted to have more exposure to gold. I just knew, dealing with retired clients and with conservative people, that I needed to phase in, and I used the excuse of the coronavirus to get what I wanted originally, which was exposure of 60%. Because of what I just showed you, because of what I know is going on in the world markets. So we got into gold. Does anybody remember this slide? August last year, we had a presentation in this very same room. I predicted the world crash we just had in March this year. So I predicted this crash that we have right there. So my prediction was correct. I could not have foreseen that the US was going to print the same amount of money they did in 12 years, just in a few months. I could not have predicted that. But my prediction was accurate that the markets would collapse. And it did. If they did not print money, this would have gone down. That's the reason we went into gold. So I want to remind you, the reason we went into gold has come. It's been hijacked with fake money, which means what? It only pushes out the timeline for it to happen a little bit into the future. It still has to happen. So to answer the question, we are staying in gold and we are staying very comfortable. I want to go through our investment strategy. I'm going to do it very quickly, but you are going to see today from my understanding, because I realize this is not what you see as clients. You look at your statements currently and your money is invested into 2 funds, and you don't know what's going on in the background, but this is actually what's going on into the background. You would all have done your risk profile. I've asked you, how much money do you need to draw in the next year, next 2 years, next 3 years, next 4 years, 5 years? This is what I do with the money. I invest the money into different buckets. So if your income is, say, 6%, 6% goes into year 1, and it goes into a money market fund. Year 2 goes into, this is risk, by the way, so the higher the number, the higher the risk. So years 2, money goes into an income fund. Year 3 goes into like a Allen Gray stable, a Coronation Balanced Defensive Fund. Very low risk fund, only has about 40% exposure to equity in total. And in year 4 and 5, we put into 6 out of 10, which are balanced funds. You'll be familiar with that terminology. And year 6 plus is your equity, your full equity, your general equity. That's the category that gold falls into. So if you take 6% for 5 years, that's 30%. So 30% of your money collectively would go into these 5 buckets, and then the rest would go into there. So 70% of your money would be in gold. Now, every single person in this room, if I asked a question, your answer to raise your hand, all of your hands would go up. Not a single person in this room has got less than all those amounts in money market right now, correct? So what I've done is I've taken the income that you need for the next 5 years, and I've put them, instead of putting them into every single one of these buckets, I've put them all into the year 1 bucket. Why? And this is my philosophy, and this is what Gavin spoke about earlier. You might not realize this, but a lot of time and effort over the last decade has gone into this investment strategy of mine, because all I want to do is protect your money. My biggest thing is I can't sleep at night making money and my clients are not doing well. I'm doing this because I want to protect your money. So how the strategy works is, if I believe that year 5 bucket, a balanced fund, is not going to outperform year 1, why would I take more risk for the same or less return? I wouldn't, right? So the logic works that you take that money and you put it into there. So at the beginning of this year, remember when we switched all of your funds out in March, when we did the switch out, because we still had money March in this bucket, yeah. And I said no, because I think even they are going to tank with what's coming with coronavirus. We cashed out everything and we put all your money into year 1, because I believed that year 1 money market is going to outperform every single one of those. Let's see if I was right. This is off 91's tool that I've used. 91 money market fund, which is every single one of you in this room has got about maybe 30, maybe 40% of your money in that fund right now. That fund over the last year has performed 6.09%. So let's call it 6% it's performed. Those 3 categories have done 3.8, 2.9, and minus 0.9. So you'll see that I was correct in my prediction that even these lower risk funds would underperform a money market. That's the reason why you've got so much money in money market. And I've had a lot of phone calls from some of the people in this room as well saying, why are we in money market? Is there nothing with a better return? I did not believe so, and I was correct. Money market even outperformed those rest. My response to you when you phoned me would have been that money market is only a parking vehicle until it's okay for me to put money back into these buckets. When the time's right, you'll be getting a WhatsApp from me again, a broadcast message, or switch you guys back into those buckets. But for the time being, I'm comfortable with where we are. I don't think that we're going to get a lot better return out of the other funds going forward, so we'll leave it there for now. Now let's discuss this one here. So even though that average there was minus 0.9, let's look into that in a lot more detail. This is the Old Mutual Gold Fund over the last, I think it's about 5 years. This is when we switched into it. This is the June date last year. That is when we increased the exposure to 60%. That is the thing that has hurt us, because we increased the exposure to there. So right now, even since I did this graph a week ago, it's gone down a little bit lower. So in essence, you've had high exposure and it's gone below when we got into it over there. So that is the reason why your statements is not looking good right now for those of you that are logging in right now. But I want to analyze this, and I want you to look at it from my perspective to protect you as a client and what I have to do to keep your money safe and to ensure that your investments are doing well. And then also you've got to ask the other question. So if we don't want to be in gold, do we want to go 100% money market? Do we want to go into overseas? Where do you want to go? So I'm going to show you the comparisons. What else is there and how have they performed? So I know that's the graph of gold since, about August this year. So especially if you become a client in August from now, it's not looking good. But I want you to keep in mind that this is a long-term investment thing. So let's compare it quickly. So we're going to be comparing it to balanced funds. So those are the 6 out of 10 funds. Gold is obviously the one at the top because you can see the graph looks like it did just now. I chose 3 funds. I'm not going to be mentioning their names. I'm just going to say that the one is the one that we're up against at Ladder Main, and the other 2 are the 2 biggest, most popular funds that if I ask who's the 2 biggest investment companies, you're going to mention those names. Those are the 3 companies. Their balanced funds have done 2.8%, minus 1.4%, and 7%. So if you take an average of that, you're looking at about 2%. You minus fees of 2%, your return would have been 0. Anyone complaining about gold because it did 34% in that same period? It's probably gone down maybe another 10% or 15% since I did that. But regardless, it's sitting at higher at what everything else is if we chose a balanced South African fund. The biggest companies in the country. So not just, I haven't stock picked any, I chose the companies that everyone would look at. If we look at SA equity funds, the returns were minus 1.7, minus 6.5, and 12.7. If you take an average of those 3 and you say you took all 3 of those equally, you'd sit at about 2, minus fees again, once again you're sitting at 0. Your return would have been 0. So once again, gold is a better return. I know that this does not look good. I realize for those of you that got your statements end of June and end of September, now you're going to get a new statement. I know it's looking terrible, but the reality is we've done better than anything else there has been available. Now, let's take the last one. Let's say you were so optimistic about the American Stock Exchange that you decided to invest your money to the American Stock Exchange. Yes, you would have done better than the other funds, but you still would have underperformed gold over the last year. But for reasons highlighted earlier, I think anybody doing that is insane, or you have to be a stockbroker. You know, if you're a stockbroker and you've got the gift of timing things and you know you can get out before the markets crash, by all means, go and do it. That's not my gift. My gift is to choose an investment that I believe is going to do well for the long term, or that I believe is going to do well for a season, and I can normally tell when it's a good time to get in and when's a good time to get out. And we've done that successfully. And that's what Gavin was referring to, because my shareholders were concerned that I was showing them figures, that I was choosing the best figures, and that not all my clients were invested in the same way. And after they did thorough research, they came out that all my clients were in the same position, and they've all done the same, and that we have in fact done well, and that our calls were right over the long term. So even if you chose America, which I think is the most dangerous thing to do right now, the one fund would have been 21, the one 20, and the other one 3. So once again, if you take an average of that, you're sitting at about 15, 16%, minus fees, you're sitting about 12, 13%. We've still outperformed all of it. So let's look at where is gold going to. Now, I've given you what I think. I know a lot of people like to hear what does other people think as well. So I've just inserted this. Goldman Sachs, anybody know the name? If you don't, they're over 100 years old. It's one of the biggest investment companies in the world, American company. This is their headline, November 18th, just a few days ago. Gold price to hit $2,300 in the next year on inflation risks. This is the article of the heading I've just read to you. Gold prices are expected to break out of the current narrow trading range and soar through 2021 as the coronavirus recession gives way to higher inflation, analysts at Goldman Sachs says. Bullion hovered around $1,900 an ounce over the past few weeks after its summer rally to record highs fizzled out. While uncertainty surrounding the US election fueled a brief rally, positive news of COVID-19 vaccine trials have pushed investors out of safe havens and into riskier assets. So the reason we saw gold tapering off, which I knew, but I'm showing it to you from somebody else's point of view, is because the vaccine came out. In the week that the vaccine came out, gold tumbled like 20%. You've got to realize, remember in 2017, I did a presentation and everyone was asking about Bitcoin, and I said, get out of it because it's picked up too much momentum. It's the same thing that happened with gold. A lot of people got into gold who are not gold people. They just got into it because there was nowhere else to invest, and they saw the short-term advantage of getting into gold. They got into gold. The problem is their reason for getting into gold is now gone, and they've now gone out of gold, and that's why it's dipped down. But we're investing for the long term. We're not investing for the next 6 months. So we are going to be staying in gold. Let me read the next part of the article. So in the near term, gold doesn't have a clear catalyst to lift or drag prices, analyst Michael Spogging and Jeffrey Curry says. Yet, the precious metal is poised to break out in 21 as inflation concerns take center stage, they add. Now, inflation, remember what I showed about interest rates and the debt? That's what they're referring to. They're referring about inflation. All this money that has been printed is going to cause inflation. It has to cause inflation. That's the negative effect of printing the money. And that's what they're concerned about. Goldman has set a $2,300 per ounce price target for gold, which equates to a 22% rally from the current levels. So imagine every time gold goes up 1%, our fund goes up between 3 and 4%. Goes down 1%, our fund goes down between 3 and 4%. Imagine if gold does 22% in the next year. If we're just a little bit patient. So as they say, there's no reason in the short term, there's no reason between now and December and January or February for gold to go up. But are we investing only until then? No, we're investing to ensure that your capital can outgrow your monthly income that you're drawing so that you can continue living off your investment. And then the last one, else it's going to become too much. I just want to read that last one. All this should continue to provide gold with a reason to go higher in the medium to long term. So with that all being said, I hope that any of you that have had any fears about being into gold don't have any more fears going forward. Thank you very much for attending our presentation. Thank you for trusting me with your money and your lives, in essence. I really put a lot of effort and trouble into what I do, and I always check what's going on. Where are we at now? I often reset the button. You won't know about it, but I reset the button. I ask myself, where are we today? Has our position changed? Do we need to make some changes? And right now, I don't believe so. I believe we're on the exact same place we were June last year. I believe that the stakes are higher. I believe there's more reason for us to be in gold right now. And I think that's the reason why it justifies us having exposure of about 60% to gold at this stage. So thank you for trusting me. Thank you for coming. Afterwards, please come chat to Gavin before he runs off. And then, as usual, we've got some snacks for you guys, coffee. Oki is going to be around there chasing you with a camera. Have some fun with that. And thank you for being here, and thank you for trusting us.